So welcome again. Welcome to our panelists. I'm Monica Summerville with TABB Group. We're a research and advisory company, and we focus on capital markets. So we focus on the institutional space. I've been covering blockchain and crypto for a number of years, since I was talking with Anna, since about 2016, when the institutions start coming in. So custody is obviously a long-standing topic we've been talking about. And for good reason. I mean, if you look at what goes on in the market, we all know that there's a big issue with crypto, with losses in the industry. Last year was a banner year, $4.5 billion lost. However, interesting to point out that about $371 million of that was in exchange thefts and hacks. And that's actually quite a big drop from previous year, 66% loss due to those kind of hacks and thefts. Whereas what's really going up is this sort of malicious insider threat, so losses due to fraud and misappropriation. But still, those headline numbers are big enough to get a lot of institutions worried about the safety of their assets. There's also the issue of lack of regulatory clarity. I'm sure that's something that's going to come up time and time today. But it is an issue for custody, so we might try and touch on that as well. This chart shows different regulatory jurisdictions, and the main takeaway here is the gray circles mean that they have no regulations in place. And if you look at custody, which is, I've highlighted that line, you can see there's lots of gray circles right now for custody in different jurisdictions. And that's, again, from the institutional point of view. So TABB Group also surveys the industry quite regularly. So we talk to institutions in the space, and one of the questions we ask them is what type of if you are investing in crypto assets, what kind of instruments are you investing in today? And you can see sort of the direct investments, whether that's crypto or tokens. That's they're both less than 50%. So there's also a question about whether that's another thing that shows the industry is a little bit wary of the custody, because obviously if you hold the assets directly, then you have to come up with a custody solution as opposed to investing in something that's cash settled. Okay, with that, I'd like to bring it back to our panelists, and we've got a really good selection of panelists. We've got someone on the technology end, a liquidity venue, and 2 custodians. So with that, I'd like to ask you all to introduce yourself and just give a little bit of background on how you operate in this space. Anna, can we start with you?
Yep, thank you. I'm Anna Shugol. I work for IBM. I'm a technical specialist, so I have actually worked really close with the customers who are interested in adopting, who are interested in moving to digital assets journey, and they were interested in having secure and trusted environments. So I was helping them to deploy some of these projects. I'm a technologist. I have a technical background, and I'm really interested in this type of new solutions.
Hi, good morning. Alex Batlin, founder and CEO of Trustology. Trustology is a custodial wallet provider. Custody is not very exciting, is it? I mean, it's kind of really boring because when it works, it's just there, and then when it doesn't work, then it becomes very exciting. So, what we do is we custody private keys, and then we manage the transactions on behalf of our clients. Really, in the end, what we're doing is securing assets both on exchange, which is a new product we've recently launched, as well as on-chain, and I'm sure we'll get into kind of some of those questions in a second as well. Thanks.
Hi, good morning. My name is Francesco Roda. I look after risk and product at Koine. We provide custody services and settlement services. I think as custody is a very important piece of the infrastructure for digital assets, and it's supposed to work. You rightly say it's supposed to work and to be there. But I think the most important bit is also the settlement of transactions at venues or OTC brokers when they involve cash on one leg, or even when they involve 2 assets. And that's where the custody and the safety of the settlement is paramount. In financial services, in traditional financial services markets, there exists the concept of DVP, so the fact that the 2 assets, or the assets and the cash are exchanged at the same time, That's what we are building. That's the piece of infrastructure that we are building in the digital asset space, a service that allow for riskless settlement and custody, of course, thereafter for digital assets.
Okay. Hi, I'm Miha Grcar. I run business development at Bitstamp, the old exchange in the world. We've been operating since 2011. We're the largest exchange in Europe and one of the few exchanges that pretty early on saw this kind of institutional type of adoption of the cryptocurrency assets.
Great, thank you. And I did want to just let the audience know we will have some time for questions. We'll try to make some time for questions at the end. There is a Slido code for our session, CCDAS. So if you have any questions, please enter it on Slido as we go along, and then they'll pop up at the end. For the first question, actually, I'd like to go to Miha. You said you've been in the business for a long time. You're one of the only liquidity venue on this panel. Let's define what institution really means in context of crypto. What are you seeing? Who are the players on the institutional side that are active in this market?
Yeah, thank you. It's a good question because people talk a lot about institutions for the last 3 years, right? The institutions are coming. But actually, what kinds of institutions these are, they differ very much from what you imagine is to be like a tier 1 financial institution from downtown Wall Street. So I would say it came in waves. First, I would say it was more institutional-like players who were deploying trading strategies that are very much institutional in nature, but very light on the regulatory side, I would say. And then it just scaled up from there. And I would say if we started out with proprietary trading companies, then moved over to a little bit more of a crypto hedge fund type of setup, then we saw the first challenger banks, private banks, some family offices. So it's progressing slowly. But in no way can we talk about institutions, the size of, I don't know, BlackRock or similar just yet. But I do see that as time goes on, as infrastructure gets built, as exchanges become more high performance, as things become more standardized in terms of custody, settlement, clearing, all the super boring stuff that we associate with, financial markets in the end. If it works, it works. And this is what is appealing to institutions. So we're not quite there yet, but I think we're much farther down along the road than we were, let's say, 2 years ago.
Great. So sticking with the definition theme and going to super boring, since you brought it up, Alex, I'll go to you. Let's define what custody means. Is it books and records? Is it maintaining the keys? What is it when it comes to crypto assets?
Yeah, in the crypto space, I think it's kind of a little bit weird because typically, as a custodian, you'll take legal hold over assets that you custody. So you then get into the questions around rehypothecation, meaning, if you're a prime broker or even a custodian, are you allowed to lend them out? Are you allowed to do anything with those, interest-bearing, et cetera, et cetera? I think and then, of course, the question, if you look at, say, FCA Chapter 6 that talks about custody, it talks a lot about maintaining records. Because essentially, if you lose your records, kaput. Then you look at the crypto space, you're no longer really looking after records because it's on blockchain, unless you use omnibus accounts. Some people do, and then you have to have a private ledger. But if you're using segregated accounts on blockchain, then your book of records is the blockchain. So then the risk factor that you're trying to mitigate against is the keys and the transactions that are signed with those keys. I often talk about us being the key and transaction management system, because if we have the keys, we make sure that they're not lost or misused, and then we proxy and re-sign transactions, making sure, because only the correct transactions go through. So it's a slightly different paradigm. It's not traditional custody. I think there will be players who will emerge, who will have accounts which are interest-bearing, and we've grappled quite a lot. Can you create an interest-bearing account? But actually, I think there are now a lot more exciting ways to achieve the same thing. So we're now seeing interest-bearing tokens, Compound Die and others, which are creating the kind of risk-bearing aspect to an asset class, and then still keeping the kind of the custodian pretty clean in terms of you know exactly what risk you're managing, which is the key risk. So I think all definitions of custody struggle to keep up with the new paradigms, and then you kind of getting old institutional players coming in, and there's a lot of still education to explain to them kind of how can you achieve ultimately the same results, whether it's capital growth, whether it's interest yield or whatever it is. But you kind of, there are better ways of doing it than simply just parking it with an old custodian. So I think we're going to be evolving this space as well.
Yeah, that's interesting. Put it in terms of language they'll understand, and risk management obviously is one of the big ones. Francesco, I'm sure you have something to add here.
Absolutely. So the beauty of this space is that you can actually have multiple models and operate under different, completely different models to satisfy your customer demand. So we took a slightly different approach when building our custody services, and our custody service is actually geared towards the settlement, the trading, the exchange of value activity that goes together with effectively the requirement of having the asset kept safe by institutions. So we work on effectively on an omnibus basis. So we don't settle on blockchain; we settle on ledger. So, and that's what effectively enables us to do real-time settlement and riskless settlement of transactions. I think it's interesting what you just said, the fact that the role of a custodian is not just keeping the asset safe, it's also providing a number of services around the assets. And there are coins which are coming out, appearing, that do have something akin to an interest being paid on a regular basis. So the proof of stake coins, that's what they do. And as a custodian, you can actually provide services on an agency basis, making sure that you fulfill the will of your clients in actually collecting this interest or not, for the, as it may be. I guess it's also interesting to notice that we are literally talking about crypto today. That's what the main focus is, or Bitcoins and other decentralized digital assets. But and this goes back to the question of institutional adoption. I guess the lack of a variety of assets to invest in is probably something that is not particularly well seen by the institutions. So institutions want a variety of asset classes, and within each asset class, they want a variety of assets to be able to effectively have a good exposure and a good investment universe. When it comes to other digital assets, assets that represent securities or bonds or any other type of value that exists and is transacted today in financial markets, then the servicing piece becomes even more important. So the collection of dividends, or the voting, the proxy voting on behalf of investors, or any other actions that actually the security or the digital asset may carry on. That's, I think, it's the important bit.
But can I add just one more point around institutionalization? So we have to be very, very careful not to bring all the baggage we have from real kind of current world into this space, because I worked at BNY Mellon. It's an amazing institution. They service hundreds of different assets in different jurisdictions, and they support instruction execution, anything from fax to phone call to email to digital. Now that's great. You're offering many, many communication channels, but that has a cost. So if you start to kind of, and then if you start adding another digital service on top of that, all those costs are going to be amortized across digital-only channel as well. So you're going to start increasing the cost of service once you bundle it into the bigger structures. So I think it's really important for us to really make the digital asset space as cost efficient as it should be, to make a real difference for people to switch from traditional rails to digital asset rails. We do have to keep it kind of pretty pure, because as soon as you bundle it with everything else, you'll see the costs slide up massively, because that's what will happen. So I think, the way we institutionalize this, we have to be pretty careful about it to not spoil the cost benefit that is here, if we can get it right.
Yeah, that's a very good point. Just switching gears slightly, because we've sort of touched on some of the technology, but we haven't gotten in depth. No matter what the customer, you're going to need sophisticated technology to make sure there's security and governance in place. So Anna, can you maybe walk us through what the technology is currently available?
Sure. So you're probably all wondering, so what's IBM is doing here, right? Because actually it's true, we're not custodians, but we're quite a big company, and we have worked a lot with many big enterprise clients, and we understand the switch to digital assets. And we obviously see the trend that the market is showing us. However, we also work with different startups. And what we provide the secure execution environment, digital vault, if you name it. We call it hyperprotect services for custodians, because we know that it's not only important to keep your assets safe, and predominantly it's your private key, which is, which leads to your asset, but also to attest to the auditors, to make them to feel sure that you can actually prove to the regulators and to the auditors that the custody that you're building, it is safe, and that it attests to all the regulations. And what we are bringing to the table, our approach is that, today you never know who's going to attack your environment. It can be somebody outsider, but can be your developer or the administrator who you fired yesterday. So we do believe in multi-factor, multi-quorum transaction signing when there are multiple participants signing the transaction. We do believe in provided trusted execution environment that is cryptographically locked by many keys, and we do wrap our keys with our HSM. So you probably know HSM, it's a hardware security module. There are some institutions that use it to make it a cold wallet, to store the keys there. However, we do see that the market goes into the warm and hot wallets. So what we're providing the HSM, and we wrap a couple of times everything inside our trusted container with these keys. And we make sure that, there is no evil administrator who can, SSH into the environment. It's all white-labeled APIs. So in summarize, we think that, there are so many vector of attacks, and how you mitigate while you try to foresee them all, and that's what we're working with. So, for example, have you ever retrieved any money from ATM, right? Have you, right, with your PIN code? So actually, it was IBM in 70s that came up with the algorithm when you can enter your PIN code, and the ATM doesn't have to be online to verify your PIN code. So, we have a couple of decades working with financial markets, with the banks, but just recently we go together with the custodian on chain from Singapore, and they trust our IBM public cloud with their custody vault. So we also work with many startups, and we do understand where market is going. And again, we're not custodians, but we understand what your guys are feeling in terms of security, being audited, and there is also compliance. So that's our approach, just, to make sure that nobody can hack into your environment.
Yeah, I think that's, just going back to that statistic I put up earlier, whereas a lot of the theft now is sort of that malicious insider. So it's something that institutions are grappling with across the board. Cybersecurity is no small subject. So that's a great point. Thank you for making that, Anna. Miha, I just wanted to jump to you quickly, because I know Bitstamp, has not been immune from having, attacks as an exchange. And I believe you've got several providers when it comes to custody and wallet. Is it you work with Ledger and Bitstamp?
Yeah.
Or?
So when it comes to custody and exchanges, sure. exchange is a big honeypot, right? It's a huge concentration of digital assets and of value. And the more these assets appreciate in value, the bigger the risk, and the more you need to invest into security. So ultimately, sure, technology more or less available on the market is all solid, more or less, I would say. But what you do with it is actually the key. So, the private keys that sign the transactions pretty much work the same way with more or less all protocols. But governance around it, surrounding the custodial solutions, how the settlements are done, and also how exchanges use custody is key. And obviously, as an exchange, some rely on self-custody. We pretty early on decided that we are not going to be good at anything or everything. So we'll just focus on one thing that we do and we do best, and that's the exchange, trading. And custody and everything else is supporting. So we partnered with BitGo, we partnered with Ledger, and our view is that exchanges should be agnostic to custodial solutions. Custodial solutions serve their clients that are mutual clients from the exchanges, and it's about enabling and unlocking all that liquidity to be able to go to trading venues and trade and offer, fair markets and price discovery. And that doesn't necessarily mean that, an exchange has to do their own custody. So that's kind of our logic where we came from. And I think it's well received from the institutional space because to them, counterparty risk and credit risk is significantly diminished once you have a more diversified and more spread out risk surfaces as a business.
Okay, thank you. And just staying with you for a moment, but this is really a question for all the panelists. Can we just talk a little bit about the difference between different types of digital assets? So we have cryptocurrencies, obviously that's traded on your exchange. There's tokens, there's security tokens and tokenized securities, which are a little different. In your opinion, do those need different custody solutions? What's happening in the market there?
So ultimately, what you custody is the private keys. And the underlying tech is the same, whether be it cryptocurrencies or tokenized securities or however you want to call it. It's all on the blockchain. And sure, for some assets, there are rules, that have been around for decades. Cryptocurrencies, I think, are a bit standalone in this regard because they are completely, they don't have any sovereign backing it, no rules governing them, which is, I would say, what gave them promise and such quick adoption in the early days when Bitcoin came out. But in general, a digital asset on the blockchain is the same when it comes to custody and how it's traded. In most of the time, depends on the protocol and other stuff. But
some are more centralized or decentralized than others. But please jump
I
in.
agree. I totally agree. I mean, it's from a technology point of view, the blockchain is the blockchain. However, you sign a transaction for an ERC20 token or an Ether itself, it's pretty much the same. I think from a purely functional perspective, decentralized crypto have no recourse, as you say. So if you lose them, you lose them. That's it. There is no central authority that you can go and cry to get them back. Whereas a centrally issued asset have some safety net in terms of the ability of going to the issuer and say, hey, I've lost my asset or my asset has been stolen, please block it and issue a new one. But it's fair to say that if digital assets are very liquid and highly traded, they probably becomes more similar to decentralized currencies because by the time you get all of your machine working to stop a theft or a hack or any other issues, then it's probably too late to re-establish and rebuild the ownership title, the adequate ownership title. So from that point of view, I would say that the more liquid, the more traded, the more highly and quickly traded the asset is, then the more akin to a crypto, i.e. a decentralized currency it becomes. So from that perspective, that's where I see kind of almost like a continuum between decentralized and centralized assets when it comes to the risk of providing custody services.
It's true, but immutability is a concept that I think is something that's new and is something that should be upheld at not at any cost, but at significant effort, I would say. Otherwise, we just replicate bad practices from the old world that you've mentioned earlier and just say, well, now we're just going to say those assets don't exist anymore and we'll issue new ones. And all of a sudden, you've changed one of the basic concepts that made this technology so powerful and transparent in the first place.
I guess, for our point, the interesting argument was, the way I view it, we're unbundling what a traditional custodian does. Traditional custodian, books and records, servicing, and identity management, ballpark kind of. And if you look at it, the books and records are going away. They are going to be managed on the blockchain or centralized exchanges. So we've now got an integration with centralized exchanges where we're signing messages to transfer assets on exchange or on chain. But then with the great diversity of asset classes, be that NFTs, be that C20 tokens, security tokens, there's no way we're going to be able to ever keep up and create the user interface and the servicing aspects of all of those. We'll be a blocker. So we took the approach is we resign transactions. So again, we're unbundling the whole space. Whoever's issuing the asset, they create the smart contracts, they create the user interface through the dApps. We have an integration with MetaMask or APIs, and all we're doing is ultimately simply resigning the transactions. So what we're able to do is effectively add the controls and the security, but not get in the way of the amazing creativity of people creating new asset classes. And I think this has been the mind shift for me. You really have to unimagine what normal custodians do and reimagine and not bring the, like settlement. And I get it, you kind of need to do that, but frankly, there's DVP on smart contracts. The settlement potentially needs to be there for cross-chain assets, but we have Cosmos and others are coming along. So we'll continuously see technology solutions to replace the old school DVP, PVP, proxy voting, margin calls. All of those are being automated right now on chain as much as possible. So I think continuously, this is the trouble for me. It's figuring out what the hell does custody mean in this new space, because you're constantly evolving. And now, of course, we're seeing exchanges considerably moving towards decentralization as much as possible, or at least zero-knowledge proofs, so that they're still non-custodial exchanges. Because why would an exchange take all that risk? They're not getting compensated for it. You guys make money off trading. You don't typically make money off the risk of holding that. So there's a massive evolution, and I think, again, I'm just encouraging people not to go down the old route of replicating centralized services on a decentralized infrastructure, because all you're going to do is bring the same costs, the same problems, and one day people wake up and go, why did we do this? I'll just go back to the centralized exchanges. Thanks very much. So I think we have to be really careful about it.
It's a good time to bring in this question of regulation. I can see there's a question from the audience. Regulators are starting to adopt specific guidelines for custodies. BaFin is an example. Separately, separating custody from exchange. Will guidelines help or hurt? Obviously, regulators are struggling to get their heads around it. What is the panel seeing in terms of the regulatory issue in various jurisdictions around custody in specifics? Does anyone want to take that?
Well, one thing that we're seeing as an exchange is, of course, custody is one of the topics that regulators are looking very closely. But one experience that at least we're seeing in Europe is that every country and every jurisdiction is now all of a sudden trying to figure out something that's just going to apply for them, which in a way can be problematic and for smaller businesses, and creates unnecessary high bar to entry into a market. For us, I would argue, yeah, that's great because we've been around for such a long time. But in reality, this market needs to have more than just one exchange. It needs to have more than just one custodial solution. And since this is technology that has global promise, borderless, being too narrow in regulating these services and businesses can actually do, I would say, harm in the short term until people figure out how it should be done the right way. But that means that we may be looking at 5, 10 years of even potentially bad regulation or too self-centered regulation. And this, I think, is a risk, at least in Europe, because there is a tendency that all the regulators who've been just idly standing by for a long time are now trying to make up the lost time. And if there does come some standardization for the whole continent, including the UK, that would be welcome, I think.
Okay.
I couldn't agree more. I think, we had something that looked very promising, the fifth AML directive, EU directive. Now, besides UK exiting, that's another question. And yet, if you look at it, it wasn't implemented as a passportable regulation. So now you have to get regulated with BaFin in Germany, with FCA in UK. The French will bring their own. What Estonia did no longer works across Europe, or never did, but isn't compatible with the fifth AML directive. Same applies for Malta. So we had this massive opportunity within Europe to create a 500 million plus market, which had been uniformly regulated. And instead, we're not doing that. So one of the competitive advantages we could have had against somewhere like the States, where you're being licensed across 50 plus states, we've lost that, and that's a real shame. I think as Europe, we could have had a competitive advantage, clear, but also consistent, passportable regulation. And then the second issue right now is travel rule.
Yeah, that's a whole section on itself.
It is, but people rushed in with regulation. They came in and said, "Yeah, fifth AML looks like everything else," but there's no concrete answer around how we implement that.
So unfortunately, we are getting to the end of the session, so I'll have to wrap it up. Thank you for your questions and attention. And just quickly, maybe 30 seconds, if we're sat here again next year, will this conversation have moved on?
Absolutely, definitely. I mean, we definitely see this shift in the markets, and we see even the very big players adopting that. We see that even the Wall Street titans, they're getting afraid of some companies that are rising, and custody will be always in place, but because, well, first you want to really keep your assets very safe, but then there are regulators, and the restrictions are getting tougher and tougher. Somebody can just knock on your door and ask you, hey, we just want to really make sure that you're compliant with the standards. So what you gonna do then?
I am particularly excited about DeFi. I think it's amazing. I think it's still nascent, and there are many, many issues. But frankly, I think if DeFi doesn't work, then the whole experiment is probably questionable. So we'll see the emergence of more of that. So keep your eyes open for DeFi. It also brings in, very interestingly, a whole new identity layer. With a single key, I can now lend, borrow, hedge, and exchange. And that's actually a pretty amazing user experience. When I demo it to people, jaws drop and they're like, wow, I never thought you could do all of that at once. So keep an eye for that.
I've just been told we have a little extra time, so if you want to
that's it. I won't bore people
anything
anymore.
else. I mean, that single user sign-on thing sounds interesting, but the identity is a whole other issue. But please go ahead.
I think in a year time, we're going to see a much better infrastructure generally across the market. So more custodians, probably more, a better way of settling transactions around the different venues, the different centralized venues where trades happen. And I also think that we will be seeing a lot more different asset classes in terms of digital assets on blockchain. The stable coins, central bank issued digital currencies, it's actually pushing quite forward this industry. And I think it will be almost a catalyst for institutions to start digitalizing value, because there will be an efficient and effective way of actually settling through something that represents fiat in some way.
Yeah, I would say that in an ideal world, the conversation in 1 year is going to be extremely boring. But then again, this is crypto, and you never know what's going to happen. But in general, I think custody will be a pretty much well-solved problem, but capital efficiency and settlements still has some way to go.
Okay, since we do have a little extra time, I'll ask there was another question from the audience that I thought was kind of interesting, that when is the institutional players going to come in? I mean, it's a question that gets asked a lot, but any opinions, the bigger guys? Any thoughts?
Well, we're working with a variety of financial institutions, and we know that, it can come any day, so you have to be really prepared for that.
I guess two things for institutional to really get into this space. The market depth has to be there. So I always quote $500 billion as a good number, maybe a little bit different, but it has to be deep enough so that if you're, HFT or any of the big kind of hedge funds, you need the depth to be able to do what you do, to have smooth, efficient markets. And then the second one is regulation. Kind of BaFin coming out with their regulation has spurred a lot of interest. So market cap and clear regulation, I think those are the two. Given the kind of budget cycles, you're looking at 6 to 12 months minimum before most of the programs in big banks would kick off as a result of that foundation being laid in.
I think regulations is clearly important. Solving the issue of counterparty risk and credit risk in transacting digital assets is important. I think what we have seen is that there is a lot of interest in banks, large institutions, to effectively, I would say, digitalize some of their loan activity. So I was actually looking at statistics, and by the end, I think at the end of last year, the CLO activity reached the same level as the pre-crisis. So banks are actually back into the mortgage-backed securities, into the asset-backed security space. And that's one of the use cases that we hear most frequently. But again, there must be a very, very solid regulatory infrastructure and a solid operational infrastructure for banks to be able to digitalize assets and distribute them, and for investors actually to play in this space.
Yeah, I would summarize it in three points: regulation for sure, infrastructure, and client demand.
Great.
And how much time it's going to take is anyone's guess.
That's right.
Okay, with that, I will wrap it up. Thank you to my guests once again, and thank you to everyone.
Thank you.
Thank you.